I'm just going to touch on things like income tax, capital gains tax, and then capital acquisitions tax, which would be connected with gifts or inheritances. Okay. So we'll start off with the income tax side of things, and this will be very much where somebody is looking to buy a piece of art for business purposes. So if you have trading premises, you're buying a piece of art and you're hanging it up in your place of work, you can claim capital allowances on that art, which is 12.5% on a straight line basis over 8 years. So you can effectively write off the cost of your purchase over 8 years. It is important that, from a revenue point of view, that it meets a function test, and that function test would be to create ambience or atmosphere in your place of work. So, for example, if you have your own office and no one has access to your office and you have your piece of art hanging in the office, revenue wouldn't be of the view that that's creating ambience or atmosphere for members of the public coming into your place of work. But obviously, if you have a reception area and you have the art hanging there, then you are meeting that function test. A lot of it's based on case law, which related to a restaurant, and in that Scottish Newcastle case, it was held that the art was deemed to be plant. In relation to VAT, again, if you satisfy the business purpose test, you can reclaim back any VAT on the purchase of the painting. VAT is generally 23%. Just as a note of caution, if you are selling on that painting, you are then obliged to charge VAT at 23% on the sale of it. So to give a working example here, if you have a painting that costs €10,000, including VAT, the VAT element of that would be 1,870, which would bring the VAT exclusive cost of the painting back down to €8,130. We look at the capital allowances then on that painting. So you have your €8,130 figure here. It's written off over 8 years. In this example, I'm using an effective tax rate of 51%, which would be 41% income tax, 8% or 7% USC, and 4% PRSI. And that has a total saving from a write-off perspective of 4,144, which means that the net cost to the business of the painting, so the headline cost is 10,000, you get your VAT back of 1,870, you get wear and tear allowances of 4,144, and brings your net cost down to 3,986. So it's a very significant saving. Point is that if you sell on the painting, you not just have to charge VAT, but you may have a clawback of those wear and tear allowances. So if you have an asset that, let's say, is written down to zero, and you sell it for 10,000, and you've claimed 5,000 wear and tear allowances on it, you will have to, revenue will look to reclaim back those wear and tear allowances. So it's just a point to bear in mind. Probably, I would think, outside of the income tax side of things, I think capital gains tax and capital acquisitions tax are where art provides the biggest long-term benefits and the biggest long-term planning benefits. There's a UK case there that confirmed that art would be viewed upon as a wasting asset. What that would have meant at the time was that if you had a piece of art and you sold it for €2,540 or less, it was exempt from capital gains tax. They've since changed the legislation on that. But if you do have a piece of art, now it would be important to note that this piece of art here that we're speaking about in relation to capital gains tax wouldn't be art that you would have purchased for your business premises. This would be art to purchase yourself from an investment point of view. And if you loan that art to a gallery or a museum in the state for public display for 10 years, the disposal of that art will not give rise to any capital gains tax. So that's quite a significant saving for people who have cash, who are investing it in art, and who are looking to do it in a tax efficient way. There's two conditions, and they're not overly onerous. So the object must be a picture or a work of art which, in the opinion of the revenue, has a market value of not less than €31,740 at the date that you actually loan it to the gallery or the museum. And the object must be included in a display to which the public is afforded reasonable access. Now, reasonable access, and you mentioned it yourself there when we were chatting, when you look at things like heritage houses, they just have to open for 1 day a year. So it's not, it doesn't mean that, to meet the reasonable access test, that people have to, that this art has to be available for public viewing 365 days of the year. In relation to gift tax and inheritance tax, I think is even better. So gift or inheritance tax in Ireland is at 33%. And, you can have a lot of cases where people might have cash and they want to leave it to their children or to grandchildren or to nieces or nephews or whatever the case may be. And fair enough, if you're leaving it to your children, you have a lifetime threshold of 320,000. But if you're leaving it to people outside your children, that threshold comes down very, very significantly. So, if you actually gift them art as opposed to cash, then so long as, similar to capital gains tax, so long as the art, in the eyes of the Revenue Commissioners, is deemed to be of national, scientific, historic, or artistic interest, so long as it's permanently kept in the state, there can be temporary absences abroad, and that would be in relation to, if we say you had an exhibition, you can bring the art abroad and display it in other countries. Again, it's not held for the purposes of trading. So going back to the very first example in relation to income tax, where people are buying art, claiming back the VAT, claiming capital allowances, that would be deemed to be held for the purposes of that would come in under the trading side of things. And again, it's the reasonable viewing facilities are made available to the public. And it's a 6-year time limit. And that's the key. So if somebody has art, or somebody has cash more importantly, they use that cash to buy art, and then they gift the art to family members or whoever they wish to gift the art to, so long as they meet those conditions, it means that can be completely free of gift and inheritance tax. And that's very, very significant, I would think, because whatever about income tax, taxes like capital gains tax and capital acquisitions tax, in one way they're very simple taxes because there's very little you can do with them. So it's, and both are at the rate of 33%, so it's quite significant and it's quite high. And these benefits are around for a number of years, but not a lot of people are aware of them, and not a lot of people use them. I think simply because they're just not aware of them. But I would definitely think, I think that's huge. And I know there's a couple of clients who I would have spoken to over the last few years who would very much have always thought that, art, it's for other people, it's not necessarily for me. But this is something I think that's available to everyone. And and it's quite simple and it's quite easy to meet the conditions of it as well.